but I do happen to day trade, so we'll see how that goes. Let's go to the next story. $14 trillion rally expects a Fed cut. What happens if they only get a quarter point? I had fun putting this one together. Bloomberg actually put out one that caused me to trigger to write this story. In the high stakes world of global markets, the U.S. stock market has been on a tear, adding a $14 trillion value since April vows, with surging 32%. This highlighted in a recent Bloomberg analysis. The current marking, Michael, they are assuming that we are going to get a 93% probability of a 25 basis point cut, bringing the federal cuts rate down from its 4.25 to 4.5 range down to 4 to 4.25. I think that they are going to cut, but I still think beyond that, expectations are for a gradual path. The Fed's dilemma is real. Cut too aggressively and it risks overheating prices. Hold back and recession fears could mount. Markets, however, have largely priced in the baseline 25. If we get anything less than a 25, we're going to see some grumpy investors. I think it's going to be 25.
Yeah, I mean, I definitely think it's going to be 25. I think the Fed has signaled that, and I would agree with the market. I mean, you can't get less than 25. It either is a 0 or 25 basis point cut. There's not much you can really do because remember, the Fed gives a guidance window. The current guidance window is 4.25 to 4.5, and that 25 basis point cut is just a guidance range from 4 to 4.25. So it'll be fascinating to see what they see. I think the real question, and I like what you put in here, is what does this mean for the energy sector? And again, we just talked about it in our last article, 1.4 trillion of investment needed into just the power generation sector. And part of that is definitely natural gas infrastructure, natural gas drilling. Well, that's going to basically flow on back. And I love what you put in here. Our good friends at BlackRock, just mostly a joke, but some BlackRock analysis suggests that if there are multiple cuts, so about 75 basis points through 2026, portfolio returns in energy ETFs could see a large increase relative to what the overall consumer CPI might see if you're sort of playing that long short analysis. I think it's extremely fascinating. I mean, you look at all these oil companies right now that have huge debt balances. Any lower in the rate cut is going to allow them to roll over their debt, continue to make investments, and really drill through this low point. I mean, I tend to sort of
nailed it.
Yes. And I tend to fall in the middle here. I think if you spend too much time on X, you'll hear people screaming, you can't drill at these prices. You're incompetent if you drill at these prices. You're not allowed to drill. It's a waste of money. And on some level, I can agree with that. But on some level, I don't agree with that from the standpoint of if there is enough cheap capital, it is you can use debt. I mean, I know it's a scary word, but you can use debt to make investments. Some of the largest companies in the world have scaled their businesses off taking out debt. Now, you have to be smart about it. You know, you don't want to go too far down the debt route. You end up over leveraging yourself, and it's actually kind of crazy. So I think the point is it's understanding how cheap the capital is and where the best way to invest. And it may not be actually drilling the wells. It may be enhancing your midstream infrastructure. It may be allocating towards, like what we mentioned, some of the power generation stuff. So I think it's going to be very interesting, but I like your bottom headline, Stu. We're going to definitely be navigating the uncertainty because that 14 trillion rally is going to hang in the balance because if he doesn't cut, some of that's going to get wiped off.
You bet. And I want to point out Walter Farrick, a Bloomberg Weekend, put out this. I want to just give him a little bit of a shout out. I think he brings up a really big point and go, why are we here? Maussan says their essay is noting the elephant in the room. The president himself wants lower rate. Authors argued that the best critiques of the Fed require politicians to confront hard decisions like balance, inequity, and growth. But don't forget the backdrop. The Fed is an expert institution in an anti-expert, anti-institutional age. 74% of Americans had confidence in Alan Greenspan would do the right thing, according to Gallup. In 2025, 37% have confidence that Powell will. Trust in the president and Congress has fallen over that period, but in 2025, listen to this, in their tenure together, more Americans have confidence in Trump to do the thing for the economy rather than the Fed. That is critical.
It is. And as he ends his quote, you conveniently left out the last sentence. That does not bode well for Fed independence. So it's going to be very interesting to see how things move forward.